This is Extra Dividends, the program where your returns are more than just dividends. Hello, everybody. My name is Jeff Barron, and it is my pleasure to welcome you to this weekend update for February 25, 2022. Even the most talented trading guru in the business would have been challenged to forecast the direction of the market this week. As has been said by so many, our hearts and prayers go out to those impacted by this senseless war. Can you even imagine what it would have been like to be awakened by your doors rattling off their hinges, the horrific sound of a cruise missile exploding a mile and a half from your home, while your young children are sleeping in a bedroom nearby? I just read a story written by a Ukrainian trader that told of his experiences. He's a financial writer and did a great job of writing the story. And it's good to read those stories to give us pause to be thankful for the peace that we have and to put the things that we think are important into their proper perspective. So we do have business to attend to. Now, I would have been the last person to guess that the week of a major war outbreak, the markets would not only not crash or be substantially down, but that they would actually finish the week having recouped their losses from a close like nearly a week ago. I find that astonishing. There is one point that's easy for me to say, I told you so. That is, no one can accurately predict the markets. Of course, the major indexes and most stocks did react to the news, and they continued to react up and down throughout the week. That's called volatility. And we might as well get used to it because my guess is it's here to stay for some period of time. And that's not all bad. My intention in this strategy is that we'll take advantage of it. This week is a good example with four of our signals that were sent out on Monday, all getting filled. So here they are, SAVE, AT&T, TPR, and CLF. So all of them got filled. And the interesting thing about this is that with the market volatility, they are all showing a pretty significant profit just within the first couple of days of being filled. So here is the track record so far for the month of February. You see that we have closed 5 positions, and all 5 that have been closed have closed at a profit. So what I wanted to point out here today was that our total single position profit for the month, adding these up, was $230. The important thing I think to recognize is that these are single position. Now, depending upon the size of your account, you might be trading in more than one position. And the number of positions that you put on for each position should be determined by the strike price. So I wanted to share with you how I handle that in my account and tell you a little bit about the effect that it has on your profitability. So let's take a look at that first. We are going to talk about U.S. Steel. So U.S. Steel has been one of our most traded stocks in this strategy. We have traded it 8 times since, just a year ago, starting a year ago. And in U.S. Steel, we have made a total profit of $284. There have been no losing trades in it. So what I wanted to do was compare how it changes when we change the number of contracts. And it's pretty simple math, really, because here I'm showing 5 contracts and the total profit on that is $1,420 compared to $284. So with a larger account, you can trade more contracts. I'm asked frequently about how you determine how many contracts you should trade per account. And I'll tell you how I do it. There's no one way that you can do it. You want to be careful that you don't overtrade your account. What I do is I take the strike price and I cut it in half. So in this case, U.S. Steel, the strike price around $20. And I'm saying that it's never happened in this portfolio that a stock has gone to less than half of its value. So I feel like calculating the risk at half is a pretty conservative way to do that. So by doing a little bit of math here, if the strike price is $20 and the stock drops by half, then the risk is $1,000. It's $10 per share times 100 shares. That's $1,000. So if you're trading with a $5,000 account and you're trading 5 different stocks, each one no more than $20, then that you have enough in that account to trade 5 times the $1,000 risk. Now that assumes that you have a margin account. If it is an IRA or a cash secured account, then you would need to consider the entire $20 or $2,000 of risk. So that's why you can trade this strategy with a $5,000 account. Now, again, continuing on with the math, if you have a $30,000 account and you want to trade, let's say, 5 different stocks in it, you can do the same. You can just increase that to 6 contracts, because at $1,000, then you are risking $5,000 or $6,000 times the 5 stocks brings you to the $30,000. Of course, you can cut that in half and increase the number of stocks to 10 to 12. So it's just a matter of doing the math. You can double it again, depending upon your account size. I have some traders in our group that are actually trading 20, 30 and more contracts per stock, but they have a very large account and they can do that. So you see the benefit again, if you trade more contracts and if you have the account size to do it. I wanted to take a moment and suggest some of the reasons why it's important to equalize the risk in all of your stocks in the portfolio. So you'll want to trade some at 5 contracts, some at 10, depending upon the price of the stock. Also, if there is a loss, the loss tends to be larger on a more expensive stock. So it makes sense that you would want to trade fewer contracts. It's easier to track the risk in your portfolio. It's easier to choose the number of stocks to trade on each trade. So if I know, for example, that I want to risk no more than $5,000 on any one stock, and the price of the stock is $20, then I cut that in half and I know I can trade 5 contracts. So I can just do that in my head and quite quickly make a decision on what the number of contracts I want to trade with each stock. So I hope that that's helpful for you. Again, that is how I do it. There's no one right or wrong way to do this. So that's it for Extra Dividends today. Remember, new signals come out every Monday morning, shortly after the open. And if this is the first time you're seeing this, new subscribers can get more information on how to become a subscriber by going to our website, getstartedtrading.com, or you can write to me at extradividends@gmail.com. Remember, have fun and be careful. Bye for now.